This is Siddharth Alwalia. Welcome to the 100x Entrepreneur Podcast. This episode is brought to you by Prime Venture Partners, an early stage VC fund led by Amit Somani, Sripati Acharya, and Sanjay Swami. Prime is often the first institutional investor in category creating tech startups in fintech, SaaS, healthcare, and education, such as EasyTap, MyGate, and SignUp. To know more about Prime, visit primevp.in. Today, I have with me Vishesh Rajaram, founder and managing partner at Speciale Invest. Speciale is a early stage fund focused mainly on B2B deep tech startups. Vishesh, welcome to the podcast.
Siddharth, it's an absolute pleasure to be on this podcast. As you know, we discussed about doing this some time ago, and I'm just glad we're able to do it sooner. Thank you so much for having me here.
Absolutely, the pleasure is mine, Vishesh. Vishesh, to start with, I would love to know about your journey as a VC. How did you enter into VC with VenturEast and before that, and what made you to start on your own after 9 years in VenturEast?
It's a long story with a lot of serendipity in it. I'll try and keep it crisp and short. I was a graduate in finance. My domain was largely in finance. I'm a chartered accountant. I started my career uh, in audit assurance and consulting at PricewaterhouseCoopers. I then went on to being a corporate banker at ICICI, where I was essentially lending out of a small $50 million book for engineering services. Um, at the end of a couple of years of doing that, I decided to sort of want to go and get a business school degree. I went to the Indian School of Business, Hyderabad. This was in the year 2006 7. Incidentally, which is where I met Arjun Rao, my co founder at the fund. Uh, I got into business school thinking I'll take a year to figure out what to do and what next. My family was a first generation entrepreneurial setup. My father had a pharmaceutical business, which he sort of founded back in the year 2005 6. So the plan essentially was to go and run this company. But life had a lot more to offer to me, in both good and bad ways. I lost my father to leukemia. When I was at school, came back, decided that the company needed its attention. So I ran the pharma company for about a year. Uh, did a lot of operation streamlining. It was a very different business. You have people on the ground. You've got a manufacturing setup. It's real world. It's not just building software. It's essentially like a hardware business. So I ran that. Applied just 101s of business, saying that you can't lose money, especially if it's your money, and did a fair amount of operational re-engineering and financial re-engineering to sort of lose as less money as I could because it was a startup. And one thing led to another, and I sort of went door to door selling inventory to different buyers, and one of those buyers essentially turned out to be an acquirer of the company. And in that year's time frame, we managed to transition the company to a large European conglomerate that essentially wanted to double down on India manufacturing. And by then, I'd sort of cleaned up the show. We had a lot of debt, different things going on. So I sorted all of that out and was essentially looking for a job. And I was very fortunate to meet the founding GPs at VenturEast, and I met them when I was in business school. Um, they made me an offer then, and I was naive enough to sort of tell them that I had something else to finish. And then I decided to go back and tell them that I needed a job, and they were kind enough to sort of take me on as their first employee on their technology fund. This was in the year 2007, and I got into venture capital not knowing what venture capital was. At that point of time, quite frankly, I wanted a job. But then I took fish to water. I loved this business. It had aspects of building companies. Some of that I had done a little bit, and of course seen the family do a little bit. It had strong aspects of finance and governance and systems and processes, which I was ingrained in, and I enjoyed then doing what I was doing. I did that for 10 years at VenturEast. I was part of their Fund 1. I was part of the Fund 2 fundraising. And then this was also a time frame that is important to keep in mind. This was year between 2007 and 2016. And between 2007 and 9, frankly, most venture in India was still more private equity-ish venture, which meant that there was not a whole lot of tech. There was not a whole lot of SaaS going on back then. And hence the first fund was sort of a very diversified portfolio across services, products, consumer, infrastructure. And it then sort of occurred to me that if I were to sort of continue in this business for the next 2-3 decades, then I need to be doing something which is more fundamental tech, possibly fundamental research. That was one. The second thing which also occurred to me was even across the portfolio at VenturEast, some were seed, some were Series A, some were growth. And I particularly enjoyed working on the superbly early pre-seed seed companies. So it then dawned upon me that I would like to spend the next decade or two just working on very, very early stage companies, companies working on disruptive technologies. And I was also keen to build a fund which transforms into an institution which will last beyond me. And just having been, an entrepreneur very briefly a decade ago, I just decided that this is the right time to possibly come out and do this. I'm very fortunate that I have a co-founder I trust immensely, Arjun Rao, and again, I have history with Arjun. We now go back with 13, 14 years from our time at business school, and Arjun's got an equal share of rough groundings, hard times in his startups, and it's good because in our business, outcomes are never in our control. Only the processes, the approach, the investment philosophies are in our control because that's all we control. And hence, it's important to make sure that your co-founder or your partners are people that you can trust and people who have real world experience. And that's what got us to doing Speciale. We said this is a firm that will stand for backing companies that are building technologies of the future. Given that we are seed, we're pretty much right at the bottom of the food chain in terms of risk. You pretty much have every risk loaded on the company. And we felt now that we're taking all the risk that's theoretically there, we might as well make it worthwhile from a return perspective. And then sort of chalked out saying we will attempt to do frontier tech or disruptive tech companies. And now I'm talking about early 2017, and a lot of this was not crystal clear on what we'll do, what sectors, all of that. But that's essentially what we chalked ourselves out for. We said we'll do early stage, and we said we'll do disruptive technologies, and we didn't necessarily distinguish between software and hardware at that point. And that's what got us going.
And it's been a very interesting journey because you come from a finance background, but you took a very deep standing for tech. What was the reason for that? Like, how did you build that expertise?
Well, I can't claim to be being an expert, but what I can claim is that I'm a learner, and I think that's the attraction towards anything tech. And also purely looking at it from a finance background, tech, among many things, presents a strong ability for non-linear growth, non-linear returns as well. I mean, I've dabbled in pharmaceuticals, right? You've got to make 100 kgs of a product and you can sell 100 kgs of the product. When you want to sell another 100 kgs of the product, you got to go make another 100 kgs of product, right? And that's how that works. But in certain aspects of tech, you're going to be fundamentally creating things that didn't exist before. In certain aspects of tech, you have the blessing of repeatability at very low production cost. Like take SaaS, take software. I mean, after a point, the only incremental cost of an incremental customer is the marketing cost of it, right? Of course, there could be servicing and all of that, but those end up being high margin products. So I think the fascination for backing businesses that could have gross margins as high as 60 to 70%, sort of what drew me to tech. And we're in a world where we have to constantly learn. There is no escaping that, and I think that's what I love doing.
Fantastic. And can you share about the portfolio companies of Special Investor? Who are they and what are they doing?
Yeah. So at this point, we've made about 10 investments across the first 2.5 years. We'll make another 7 to 8. I think our belief is a portfolio construct will be about 18 companies for every fund, and every fund will invest over a 4-year period. We're in the middle of raising our second fund, which I think we hopefully will have it sorted before the end of the year. In terms of Fund 1, we've made 10 investments, 4 on the hardware side and 6 on the software side. On the software side, we've sort of got two broad categories. One is developer tools and infrastructure, where we've got companies like Scapic, which is a no-code tool for creating AR, VR, and 3D content. And applications include advertising and commerce. We've got Kawa Space. Kawa is a company that helps draw intelligence from space for business decisions. Again, no code, no product. You click in and you can sort of define outcomes. TotalCloud is a developer tool solution for managing cloud infrastructure across a multi-cloud environment. And some of the key things we offer is security, compliance, and among other things, cost management. And I think the last one in that category is a company called iauro. This is a product development company that's sort of pivoting from having people develop products to sort of going down the no-code route. We've got a couple of them on the SaaS side and mostly SMB SaaS. But what's exciting for us in these SaaS companies is that they are deep techish in their own nature, which is they sit on the convergence of a couple of moving or evolving trends. Both these companies, incidentally, sit on the convergence of conversations and AI. One is a textual conversation, the other one's a voice conversation company. A voice conversation company is called Wingman. They're a YC company. One-line description, they're a revenue intelligence platform that listens into sales and sales SDRs and customer conversations to draw insights. The other company is called TrueLark. This is a conversational AI company that helps small businesses manage customer calls and bookings. So one of the sectors that they focus on is hospitality, where they essentially take in customer calls and convert them into revenue and bookings. So that's on the software side. Again, we're careful to try and make sure that there is some element of technology moat, if not immediately, then at least presence levers of technology for the company to differentiate and innovate. And hence, we believe that those two categorizations, being developer infrastructure and the other one being convergence of voice and AI, are all technologies of the present and the future, and will sort of build good outcomes. On the hardware side, there is a little bit of thematic nature there. We spent some time on the robotic space, and we ended up working with some very smart founders who run now a company called Cynlr. Cynlr essentially builds the vision and the intelligence, which in other words means the eye and the brain on top of an existing robotic arm off the shelf to make it do human-like tasks. So today a robotic arm can do a few things, and it's reasonably restricted in how it can do what it can do, because while it's programmed and all of that, it does not have a brain and an eye to sort of decide on the go. And this company essentially brings that element to it. So it's got some deep tech in terms of DNN, in terms of machine vision, and the convergence of both hardware and software to build hard to build solutions, if I can call that. We then spent some time on photonics. When I started, I didn't know what that meant, but then I quickly realized that it is a world of optics, and optics is generally quicker, faster, and better than electronics in multiple industries. And that then led us to spending time. We spent time on seeing if optics can be used on top of chips to sort of make them function faster, better. One of the other use cases that we really liked was use of optics for communication. Today, communication is typically done using RF, and that's limiting in both terms of cost and bandwidth. And we think optics can do what fiber optics did for the internet for, let's say, telecommunication. And we backed a company called Astrogate, which essentially builds optical communication systems for communicating between ground and space and for communicating interspace. Very exciting company. We think they're it's just the tip of the iceberg. I think in terms of what they can do for intersatellite communication and deep space communication is quite phenomenal. Of course, within the fund, one of our other favorite companies is Agnikul, which which is in my mind sort of the SpaceX equivalent for the Indian markets and the current situation. This is a company that's incubated out of IT Madras, excellent founders, and I think what drew us was that they were sort of building a solution for a white space within the launch sector. Couple of thematic shifts: satellites were getting smaller, cost of launch was getting lesser, which essentially meant there were a lot more people building satellites to send out. And the big challenge was, while satellites were getting smaller, the rockets were getting larger, which meant that satellites had to wait for months and years to get onto the payload, because if you're a 50 kg satellite and you got a rocket that's 60 tons, then you're in the queue to when you will be launched. And then that said, that can there be a methodology for manufacturing a rocket which essentially will bring down the time from years or months to days? And can there be a approach to designing these rockets which is very much modular or Lego blocks like, that you can upscale or downscale the rocket depending on the size of the satellite? Essentially, think of it as mass customization of rockets for satellites, and that's what this company does. So that sort of gives you a sense of what we've done on the hardware side and what we've done on the software side. I haven't covered the company that we exited recently. It was a good exit for us, triple-digit IRR. This was a company in the gaming side. It was sort of our experiment to do something which was B2C, while something that still had strong tech moats in it. This was a company that it's called Pocket 52, and what excited us was that they essentially developed a gaming engine ground up with strong layers of cryptography, and things like that are hard to build. Most people license it from outside, and these guys were building that ground up, and that's what got us excited when we were sort of the first check in them, I think about 2 years ago.
And you exited this to a larger.
It was an M&A. Uh, yeah, so we sold it to a larger gaming.
Fantastic. And I believe you have some exits on the personal side as well. You are an early investor in Vogo.
Yeah, I think we've been fortunate. We worked with a few other stellar entrepreneurs, and I think between raising the fund and getting it up and running, we did a few investments. Vogo was definitely one of them. We were first investors and backers. Worked closely with Anand, Paddy, and Sanchit. Saw through the experimentation, the market creation of bike sharing or bike rentals for short haul travel. Saw that take off. Was sort of part of the very hard journey of transitioning from car rentals, which was the first thing they did back then, to now doing what they do really well, which is a bike sharing network. Yeah, we exited the company in sort of the follow-on round after that. We were also early associates with Czech Guardia company, which we sold to TVS Automobile. We were early investors in a company called Surukam, which was a legal AI company that essentially had the capability to read documents, understand them, and do a bunch of things on top of it, like extraction, uh, then understanding what's being extracted, and then sort of rule book comparison, contract building, all of that. Again, a very deep problem to solve for. It's superbly complicated, because not only do you need to understand the paragraph, you need to understand the preceding paragraph and the following paragraph to know the context of the legal clause, etc. Terrific team there again. We had an early acquisition from the Symphony Group, so we had a good exit there as well. Exits have been good, but we know we're backing deep companies, and sometimes the waiting period has to be longer if you want to create non-linear upside, and I think we're aware of that, and we're playing for it.
But I believe this has been a fantastic journey where you spent the first let's say 10 years in learning venture capital and learning it deeply at VenturEast, and then you went all in, and had some personal exits which you shared, and uh, one on from the fund. So, do you believe India has the right timing for exit? You have seen like five of them. It's not plain luck. It's a repeated pattern now. By investing in tech, and those exits, don't have to wait for, let's say, 10, 12 years in a company's lifetime for that.
So I think, let me break it down into three parts. I don't know if I have a perfect answer, but I have a few thoughts. I think The rest of the world is now well aware that India is very well capable of building technology. And we have some very good examples of not only building technology, but also scaling technology, right? So I don't think we have a situation where people doubt the capability of innovation coming from our country. There are trends that are there. I think the belief is we may be better in SaaS than in hardware at this point of time, because there are more successful SaaS companies than there are in the hardware side. But these are all cycles, and I think in a 20-30 year time frame, all cycles will sort of see their full turns and full life cycles. The important part to keep in mind is that real value comes typically when you scale companies, 6, 7, 8, 9, 10 years. I think 3, 4 years ago, it was an unwritten rule that strong value creation takes about 10 years. Of course, now there are examples like Postman and a few others which essentially show that it could be sooner. It can't be 2 years or 3 years for sure, but I think it's more in the 6 to 10 year time frame, if not shorter. And if you're truly playing out for the big wins and building big companies, and you've got founders that have the vision for building these big companies and building them over a decade or two, which is generally how long it takes to really create a lot of value, then you go all out for it. But then you're also in certain situations where the company itself is riding a technology curve that may not be there for 7, 10 years. It may be shorter, and in those cases you have to then iteratively find ways to transition the company, and you have to make sure that your sector is sort of still in vogue, and it's still in fashion, and it's still admirable, and then you find a way to do it. In all of this, it's important to make sure that capital efficiency is maintained, and capital efficiency I define as exit value by capital consumed. And one of the draws towards doing software and industrial hardware is that we generally think that the capital efficiency is 1.5 to 2 times more than the consumer startups. Of course, consumer startups have much larger outcomes. You've got more unicorns on the consumer side than on the enterprise side as we speak. But the capital efficiency is what attracts us to doing what we do. In addition to the fact that we really enjoy doing what we do, and it's deep in our DNA to do what we do.
And uh, India, you have seen, the last, I would say, 13 years of venture investing. Do you consider today to be the most exciting period, or what? How would you classify today as compared to the rest 13 years you have seen?
Well, if you ask me today, I think significantly ahead and better. If we do this podcast 5, 10 years from now, I think I'll say the same thing. Uh, I think certain advancements have been made just in terms of technology infrastructure. And I think culturally, the entrepreneurial ecosystem is also evolved significantly from when I started. Uh, Investing in 2007, 2008, your typical entrepreneur persona was someone who spent 15, 20 years in the domain, single founder, has been at this for 5 years already, and then is raising capital for growth. And today, no, the spectrum is much wider. You've got anywhere people just graduating from college to sort of taking an idea to slightly more senior folks, and you've got people in between them. I think what's fundamentally changed is the appetite for risk. There is no stigma attached to failure. People don't worry about failing. People don't worry about getting a job if this doesn't go anywhere. So I think they give it all they have in sort of how they're building these companies. I think the environment is also different. Failing in a company 15 years ago, I'm sure had a lot more taboo to it than having a startup that went down now. People are ready to live with that situation, and I think the world is seeing failure very differently from how it saw 2 decades ago. I think that's the big shift. Everything else is technology trends and shifts, and they keep shifting constantly. And I think, which is why I said 10 years from now I'll have the same thing to say.
And what do you think are the two, three tailwinds behind the sectors you invest in?
So on the hardware and the deep tech side, I think there are quite a few things. I think there are 2, 3 curves. One is just the maturity of optics, the prices of lithium sort of stabilizing. I think we're seeing that there are technologies which have seen their cycle once and now beginning to see their cycle twos. And generally, cycle one is where there's a lot of learning and unlearning. And cycle two, in some of them, is when their commercial viability and opportunity sort of represents itself much better. And I think some of those typically lean on and support our hardware companies. If you take Agnikul, for example, 3D printing is one of the core elements of it, right? And trying to do this 15 years ago was virtually impossible, uh, versus trying to do it now. Take our robotics company. Now it's a convergence of both machine vision and which is optics and DNN models, and clearly not something that we could do 7, 10 years ago. Uh, if you take our optics photonics company, same thing applies to it. Clearly, on the software side, it's also the question of evolution of the market, more people using software, and hence that sort of having a, a ripple effect or a snowball effect. A lot of these we couldn't have done some time ago, and these are opportunities that are emerging off other opportunities or other trends that constantly move. And hence, we're not a single sector fund. We're not a robotics fund. We're not a space fund. We're not an EV fund. We have ultraviolet in the past. We don't do only that. I think we see what are the trends that are coming into economic viability that would be disruptive or additive to a large market. We see if these are founders who can build this. We think whether these outcomes can be about $100 million for us, and then sort of get into these companies.
And so, one of the key things which you mentioned is, there should be market trends which are currently very live. For example, in Wingman, they are building software for SaaS companies. Like the uh, salesman, currently the salesman in a SaaS company can use it, to enhance his closing rate, enhance his sales pitch. This would not have happened, let's say, 5 years ago when India SaaS was not known, or even the global SaaS was not as good as it is today, right? So today is the perfect timing for it. And kudos to you spotting this. Yeah,
Absolutely. Abs- I, I, that's on the market side. And I think we're also reaching a point where voice transcription, understanding voice, um, it sort of reached a certain amount of maturity that the big tech has sort of led its way. And then we're now using
yeah,
AI in a very contextual and a very specific way. I think one of the things we believe is while there is AI, we're big believers
yeah,
of AI that works in a very narrow scope than general AI. And I think general AI is a lot more harder to sort of build out. And hence, sort of building an AI solution that works within a certain sector, within a certain segment, with a lot of known things around, such as customer, product, all of that, then I think then the accuracy rates are a lot tighter. The standard deviations are a lot lower, and the algorithms can work a lot better, right? So those are also timing wise, all of them sort of coming in together for it to work. Of
yeah.
course, most importantly, you need the smartest of founders to be working on that problem. And I think in strings, the combination of Shruti, Shrikar, they're pretty strong.
And you mentioned on the founder side. So you have worked with both B2C companies and B2B companies. What are the key, qualities or trends, if I ask you, they are in the B2B founders? Because I believe both come from a different DNA. Uh,
I think the common denominator is hustle, ability to survive, and desire to survive and build. Right. I think that's sort
yeah,
of common across both because capital is always scarce. But then I think the markets otherwise are very fundamentally different, right? Particularly the go to market, uh, the the customer satisfaction and the ability to pay. All of those I think are fundamentally very different businesses. And I think generally the B2C ones need a lot more
yeah,
capital to play out, which means that the founders themselves need to first understand that and understand that fundraising is not a seasonal job; it's an everyday job. I mean, you've got to be constantly fundraising in some of these companies. Uh, and I think in the B2B, while you do need capital, and it's not that you do one round and you're done. No, they need capital, and there is a certain amount of capital that typically goes towards sales and marketing, which which sort of as the company grows needs more money. But there are strong proof points at each level. At the pre-seed level, you're looking for founder market fit, and at a seed series A level, you're looking for product market fit, and then at B, you're looking for go to market fit. So in sort of the in all of those cases, some parameters, some yardsticks for evaluation are largely there. In B2C, it's a lot more complicated. Uh, you know, for A category, 100,000 users are good. For B category, 1 million
Yeah.
users are good. And then stickiness and downloads and utilization, engagement. I think it's a completely different hard problem to solve for.
And sometimes you'll be measured across daily active users and monthly active users. And once the market is,
I think if you're a smart founder, you will be setting the metrics that you get
yeah,
evaluated on, and that's what you should do, as against sort of fitting into other metrics. And yeah, I interact with a bunch of, not everything that we've invested in, but lots of other companies where we see very smart founders building B2C
yeah.
companies.
And I think leaving them out must be hard for you as a thesis, because you see like brilliant founders in B2C who are in touch with you.
See, you know, the venture capital job is a hard job to do. You need to make
Yeah,
money. That's the ultimate goal. You need to make money for
yeah,
your LPs. But you need to make money for the LPs in a strategy that is repeatable,
yeah,
that you understand, can relate to, and subscribe to. That's the
yeah,
core. Getting a strategy that makes money is different from getting a strategy that is relatable by you as a fund manager and repeatable by you as a fund manager. And I think my DNA and I think my partner's DNA is a little more inclined towards saying, let's take 75% of the fundraise and go build product and R&D, as against saying, let's take 60% of the fundraise to go do sales
yeah,
and marketing. And then a natural byproduct of that inclination is we end up doing more enterprise software and industrial
yeah.
hardware products, which end up being deep tech or frontier tech or whatever is the next nice word used to describe that. Uh, and that's what we like doing more. And hence, while money can no doubt can be made on the
Yeah,
B2C side and in large numbers, and you've got a lot of great top quartile, top decile VCs that show us consistently they can
yeah,
do that. We have high regard for them that they can repeatedly
yeah.
do that. And we think we want to build ourselves a strategy that we can repeatedly do. And we're sort of showing some very early signs of doing that in what we're
Yes.
trying to do.
I think that awareness is fantastic. So, tell me, Vishesh, how have you evolved, as a person in the last 13 years in this industry? Like, what are the fundamental changes which you see in yourself as a person?
I think nothing surprises me
Yeah.
these days. There's just so much to learn, there's just so much going on. But I think a certain awareness needs to be there as an investor on what is your role to play, what is the specific thing that you bring to the table, and what outcomes are you aspiring for.
Yeah.
Well, and then let me be clear, these are just expectations that you need to write somewhere so that you don't keep changing. But none of that may always play out, right? I think it's just good to have a lot of situational awareness of what are you trying to do and what your role plays, so that you don't either end up under investing your time with the portfolio company or over investing your time with the portfolio company, and you find ways to constantly understand and manage expectations on both sides. I think the one thing that I've evolved that sort of stands in my mind is I've evolved to saying let us have
Yeah.
clarity in whatever we do, because as it is, the business is filled with
Yes.
ambiguity, meaning a startup, etc. So to the extent you have clear views, let us communicate that
Yeah.
clearly to each other. Let us not hold back our communication or founders hold back their communication. Uh, and let's make sure that we have a free flowing exchange of information so that there's no information asymmetry. Plans may happen, may not happen, companies may fail, may succeed. I mean, all of them is a derivative of market, customer, founder effort, capital, and a bunch of other things that go into that magical
Yeah.
equation. But the one thing you want to have in all of this is to make sure that there is clarity and communication is simple between the portfolio and the investor, and expectations are recalibrated constantly if they are changing constantly. Well, I think there are many other things that one changes. I end up doing a lot more
Yeah.
reading now than ever before. and then you sort of building certain habits that that help you in the job. I mean, if I were in the shop floor in an automotive company, then I would have done things
Yeah.
very differently because that's what's needed for the job. Certain things are needed for this job for you to sort of build this with a certain sustainable way, and we've got some excellent people who've set examples of trying to do what they do. So we're constantly learning. That's the other thing. Other than awareness, the other piece is possibly just learning.
And what are you reading right now, if I may ask on that point? And what are your habits that you have built? You think uh, make you.
Well, I have to confess, I'm not very good at reading large
Yeah.
volumes of content, and hence I think between a bunch of subscriptions on Substack and what comes our way on and following smarter people on
Yeah.
Twitter, just enough to read. Yeah, and we've got a portfolio of 10 companies we're sitting on top of, and I mean sitting, we're
Yeah.
working on. So, and we've got a new fund coming up, so there's
Yeah.
enough going. I think uh, I'm always a couple of hundred newsletters behind my reading anyways. So there's I still have catch up to play on weekends.
And what about the habits that you were mentioning? What if I may ask you, what are the habits that has developed Vishesh of
I,
today, who is a successful VC?
I think it's just very individualistic habits. None of what I do may or may not have relevance for the
Yeah.
business I'm in. I think I generally hit the
Yeah.
bed early. I'm up very early. That gives me time to sort of do
Yeah.
things very
Yeah.
early on. Um, I'm I'm very organized. I sort of paranoia to make sure I don't miss out
Yeah.
on things. So I'm pretty tight on
Yeah.
my tasks and my calendar. I think the only thing that I have is time, so it's very important on how I prioritize and
Yeah.
allocate my time. So those are two or three things I'm very picky about. But other than that, I'm just another normal man.
And you have been, a VC, and then as an individual angel, and now a VC again. We see many folks entering into the startup ecosystem as investors, either with previous exits or HNIs, or even CXOs of large corporates, in the hope of, this is a wealth creation industry. Is it so? What do you believe?
That's a very complicated answer to give. Um, this is a hard industry to create a lot of
Yeah.
wealth. It takes time. You need to be building that strategy that is repeatable and successful. And I think maybe on a couple of cycles of repeating, you possibly would have made that
Yeah.
sort of wealth. Uh, I think this is an industry you come because you're either naive, gullible, or you
Yeah.
love what you're doing. And then over time, returns are a byproduct of doing
Yeah.
what you love doing. Otherwise, it's a hard industry to make a lot of carry. I think there will be a handful. If I roll back 3 years, there would have been a handful of funds that have made carry. But I think in the last 2 3 years, things may have changed. You've got, of course, a lot more blockbuster exits coming up,
Yes.
etc. But otherwise, it's a hard business to build a strategy. There's one thing is to invest in a company, and there's an internal joke that giving our money is among other things easier
Yeah.
to do because you're
Yeah.
giving. But taking back is an order of
Yeah.
magnitude harder, right? And then building a process to give and take, and then making it a cycle is where the the core IP sits, or the core process sits for great funds. I think that's what we aspire to do.
Thank you so much, Vishesh. It's been a fantastic conversation with you, learning about your experience and the insights you have built in 13 years in the venture industry.
I'm very humbled that you asked me these questions, putting me in a position of having knowledge. And I must confess, a lot of this is just on the ground learning what founders tell us and how we pick things from our vantage point. And I keep saying I at least have a couple of more decades in this industry, and I'm here to sort of enjoy that journey and ride, and hopefully we'll do great things along
Yeah,
the
you,
way.
you plan to enter with some gray hair and exit with a lot of gray hair in this industry.
Yeah, I came in when I was
Yeah.
23, so I had a lot of black
Yeah.
hair by then, but I'm
Yeah.
getting there. I have a lot more white hair now than before.
Thank you again, Vishesh. It's been a pleasure.
Enjoyed it. Thanks so much for having me here, Siddharth.